Hi, I'm Jo Pratt and this is a recorded lecture on the topic of inheritance tax. This recorded lecture introduces the concept of inheritance tax and looks at the main steps to the inheritance tax calculation. We will be using the material and examples which can be downloaded from the page prior to this recorded lecture, and if you haven't already downloaded those, I suggest that you go back and do so now. Inheritance tax is generally thought of as being a tax on someone's death, and while inheritance tax is payable on someone's death, that is not the end of the story, and it is also payable on certain lifetime transfers. This is because if it wasn't payable on a transfer during an individual's lifetime, everyone would simply give away everything they owned right before they died in order to avoid inheritance tax. We're going to be looking at the two types of lifetime transfers and how you define them and what the tax consequences of them are. The two types of lifetime transfers are potentially exempt transfers, usually referred to as PETs, and chargeable lifetime transfers, usually referred to as CLTs. The definition of a PET is basically a gift by an individual to an individual. By contrast, the definition of a CLT is a residual definition. It's anything which is not a PET. But basically, for the exam, it is gifts into a trust. So what does a PET and a CLT mean for tax purposes? Well, a PET means that no tax is payable during the donor's lifetime, the donor being the person that made the gift. Remember that the PE part stands for potentially exempt, and a PET is exempt during the donor's lifetime but may become chargeable on their death. We do need to deal with PETs during the donor's lifetime, however, because it is important that you calculate the amount that would be chargeable and use any applicable annual exemptions which may be available. Annual exemptions may be allocated to PETs in preference to CLTs depending on the timing of the gifts. The value of a PET is frozen at the date of a gift, and so even if the gift that was made is one of, for example, property, which might increase in value before the donor dies, it is the value at the date of the gift which matters. The scenario in which a PET becomes chargeable is if the donor dies within 7 years of the date of that gift. And then there will be tax potentially payable calculated at the death rates, which we will be looking at shortly. A CLT, by comparison, is chargeable lifetime transfer. The C stands for chargeable, and therefore it is chargeable even while the donor is still alive. So there will potentially be tax to pay during the lifetime at the lifetime rates of tax. There may then be further tax payable if the donor dies within 7 years. And that would then be calculated at the death rates. Relief will be given on the death tax for any tax that was paid during the lifetime. So there would never be a double charge to tax in respect of a CLT. So the first step to any inheritance tax question will be to calculate the lifetime tax on any lifetime gifts. And that is what this first pro forma is for. You can see that we have a column here for a CLT and a column for a PET. But a question may have any number of CLTs and PETs in it, and we do recommend that you set out your computation with those all in columns side by side. This is the way that we've set out the computations in our material, and we've also provided a blank computation which you can use when practicing questions to save you some time and until you've learnt the computation off by heart. The first step in this computation is to calculate the transfer of value. That is the amount which the donor has given away. Now this is often simply the cash value if it's a cash gift, or the value of the asset gifted if it's a gift of a specific asset. However, in certain situations, it is necessary to calculate this value by taking the value of the whole estate before the gift and deducting the value of the whole estate after the gift. This is often referred to as the diminution in value concept. It's the loss to the donor's estate in giving away what they've given away. The situation in which that might be different from the market value of the asset gifted would be, for example, where they've given away shares and reduced their shareholding from a controlling interest to a minority interest. There are other limited examples. For example, if you gave away one of a set of assets, but shares is the most common scenario where you will see the diminution in value concept applied. You then apply certain exemptions, and we will look at the detail of these over leaf in just a moment. At this stage, we deduct the marriage exemption and the annual exemption, and you can see that for the annual exemption, you deal with 2 years of annual exemption, the current year first and then the previous year. So if we turn to the next page, you can see some specific detail on the exemptions. Looking at the annual exemption first, it is £3,000 per tax year, and this doesn't change between Finance Acts. It's always set off chronologically against the first gift in any tax year, even if that first gift is a pet and it may seem that the annual exemption is being wasted. Very unusually for tax, any unused annual exemption can be carried forward, but for 1 year only. And as I've already mentioned, you always offset the current year before any brought forward annual exemption. The other exemptions we'll just touch on now. There is an interspouse and civil partner exemption, and that is for an unlimited amount. Any gifts between spouses or civil partners are totally exempt. There is also a small gifts exemption. This is to cover gifts to friends and relatives that you might give for birthdays or Christmas, and covers anything up to £250 per donee per tax year. If you've made more than one gift to the same person in the year and the gifts total more than £250, this exemption will not apply. It only applies to gifts under £250. Anything above, and you ignore the small gifts exemption. The marriage exemption crops up quite regularly in the exam. It's available for any gift that happens by reason of someone getting married, and therefore the marriage must actually take place. The amount of the exemption depends who makes the gift, and if it is the parents of the couple getting married, they can give up to £5,000 each. Grandparents and the bride and groom themselves can give £2,500, and anyone else £1,000. Unfortunately, neither the small gifts nor the marriage exemption amounts are given in the tax tables, so you do need to learn those. Finally, there is normal expenditure out of income. This is to cover any regular payment which is made out of an individual's income, not their capital investments, and which does not affect their standard of living. It can cover simple regular presents like birthdays and Christmas, but it can also cover things like payments for school fees and just general upkeep of somebody's life. So the normal expenditure that a parent or a grandparent might make towards their child or grandchild, for example, would not be caught by the inheritance tax rules.